John, you good?
I am.
Tony, you good?
Good.
All right. What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How's it going, bud?
Hanging in there. By the time this comes out, it'll be after Christmas, I believe. So we are very close to Christmas. So it's an interesting Christmas this year. I think that goes for all the holidays. But I think, like anything else, I think everyone's looking forward to seeing how this year shakes out and just enjoying whatever time you have with whoever you're having it with. And, we're hanging in there.
Yeah, I know, when I was in the process of moving down to Florida about, it wasn't a month and a half ago now, I was hoping I'd be able to come back at least for Christmas Eve or the days preceding it, but decided just to stay down in Florida because, things are just crazy. And, people down here are not doing a lot of the social distancing and mask wearing stuff. And with some older relatives in my family, just wouldn't feel comfortable. And they're not even really getting together for the most part. Usually we have probably 30, 40, 50 people in a house. And, I think everybody's in groups of like 2 to 10 at most. And that's just a larger family. So, it's going to be a little different, a little bit disappointing, probably tons of FaceTime with everybody on Christmas Eve and Christmas Day. But yeah, it's not the end of the world so far, right?
Exactly. I think you're right, because I actually have some family that has been traveling back and forth to Florida, and you just see they're like going out like it's normal, like there's nothing going on. But good, bad, or indifferent, I'm not here to tell people they have to wear a mask or not, or they should social distance or not. But it's crazy when you just look around and you see people. Basically, I think the American culture is basically it's gotten old, right? The novelty is worn off, good, bad, or indifferent. And like you said, I think people are just they're gonna do what they're gonna do, good, bad, or indifferent, and we'll see how it shakes out. But we're in the same boat. We're not having 30 people at Christmas. It's probably gonna be a handful, just immediate family, like mom, dad, brother, stuff like that. So, but it is what it is, right? Can't change what's happened, and I don't think we're gonna be able to change what's gonna happen in the future. We're just sort of here, going through the motions for the most part.
Yep. Got to do what we got to do. But with that being said, let's jump into today's episode. We got a really great guest on today. Excited to hear more about him, hear his take on things, and pick his brain a little bit. So with that being said, Tony, thank you so much for joining us.
Hi, thank you, John and Chris. Really happy to be here. My name is Tony Coretto. I'm a real estate investor, small real estate investor for probably about 25 years now. I grew up in Canarsie, Brooklyn. Go Brooklyn. I migrated north, and now I live in Woodstock, New York, after having sold my database marketing business a few years ago. Now I'm spending more time on venture investing, real estate investing, and I'm also an entrepreneur in residence with NYSERDA, the New York State Energy Research and Development Authority. I help mentor startups there. So I still keep my hand in working with startup companies and working with real estate and real estate investors and my network. So keeping busy.
Awesome. So just obviously more of a real estate focused podcast. What has been your experience? Like, what types of deals have you been in? Has it changed throughout the years? What have you been involved with?
Yeah, usually, my first, dipping my toe in the water as a real estate investor was probably in the early 90s when I bought a co-op apartment in Brooklyn, kind of a market that I knew, and rented it out. And that actually turned out to be a really good investment. I held it for probably about 15 years, probably tripled my money on that. I also, I bought an apartment for my mother in Brooklyn. She needed a place to live. That was a good investment for me. She lived there for probably about 15, 20 years. Then, as I started to get more sophisticated, I began to look more into multifamily real estate. The returns were more attractive. I'm a buy and hold investor, very conservative. I don't believe in debt. I believe in just paying cash for properties and holding them forever. So that's been, my focus over the last, I'd say, probably 7-10 years. And initially, was looking to get in terms of syndications, and that's how I ran across Jonathan. Was in a great syndication with him. that turned out to be, one of 5 syndications I was involved in over the course of about 5 or 6 years, and it turned out to be, one of only 2 that were successful. His was by far the most successful that I was in. The others ranged from outright fraud on 2 of them to, poor management on one of them to, caught in the wrong place at the wrong time, with upper end New York City real estate going into COVID. So unfortunately, I have a boatload of experience with what works and what doesn't work with syndications. My own feeling now is I have 3 rental properties now in addition to my primary residence that are multifamily and 1 apartment. And that's what I prefer because I can control it. I don't have to worry about other investors. I don't have to worry about leverage. I don't have to worry about somebody pulling the wool over my eyes. I know exactly what's going on. I can visit the properties, knock on the doors. The tenants know us. We are fair people. We're good people. We make a great return, provide a service to the community, and are doing well with those. So I'd have to say that, unless the next syndication comes from Jonathan, I probably won't be doing any more syndications, but I will definitely be looking for more, MFRE in my local area, which has been booming. We live in Woodstock, and we got up here. We had a country house up here for 10 years, and we decided to move up here full time after I sold my business and our kids graduated college and left home. So we've been up here since the end of 2017, and of course now it's like the best place in the world to be. And 500,000 New Yorkers attest to that. We've had a ridiculous influx of people from downstate driving real estate prices up. Demand has gone through the roof, and the markets have really tightened. So I was able to pick up another property in September. We sold a couple of multifamilies in Troy, New York. We were in student rentals for a while, and we got out of that market, became too competitive. Prices were being bid up by bigger entrants. So I sold those at a nice profit, and then happened to run across on LoopNet a private deal with a guy in Woodstock, and was able to buy a multifamily at a not crazy price. And so, that's kind of a short synopsis of a few years of real estate history.
No, I think that's interesting. I think a lot to talk about. It's just funny that you bring some up of the bad experiences with syndication. When I was getting started with John at Toro, maybe 5 years ago now, I was at a birthday party with my dad, who was 62 at the time, and a lot of his friends. And as I was getting into real estate and doing some of the stuff, they were all like super nervous and antsy because obviously all the Ponzi schemes that had happened in New York, and they were involved with, I think, they'd been involved in like the Bernie Madoff one and like other ones. And they were like, no, like, don't do that. How do you know they're really buying stuff? Like all this stuff. And I was like, yeah, I'm pretty sure they are. And, I'm doing the best I can. And, I've seen some of the paperwork. But I was like, I guess I'll find out. Right. Luckily, John wasn't, fraudulent and screwing me over at the time, which was nice. And I don't think he ever has been. So good to know. But yeah, that stuff does happen. So it's pretty interesting. I don't know if you want to start there a little bit, talk about some of the good versus bad experiences, and
Sure. And what I can quickly say about that is that it's very, very difficult to do diligence for fraud, because by their very nature, fraudsters are good at what they do. They know how to get the paperwork together. They know how to get references together. They know how to put a website together. They're pretty good at making things look good. Mm-hmm. So it's practically indistinguishable from a non-fraudulent deal. But what I have to say in hindsight is that I learned quite a few lessons on that. One is, the workspace. So at the time, the people that I was investing with, this fraudulent deal, were in a co-workspace at a WeWork. That should have raised a red flag, because what are you doing in a shared workspace? With an office, two offices, and a shared workspace. If you're bona fide real estate investors with he purported to have a family office and represented high net worth individuals. It's like, what are you doing in a shared workspace? Should have been a red flag. Other red flags were, even though my attorney had looked at the documents, in retrospect, after we had another attorney look at them later, after we had discovered that this was 2.5 years into it, when it became apparent that some of the documents looked less good than we had originally thought. They looked like they had been cobbled together from bits and pieces of other legal documents, because there were subtle inconsistencies between parts of them. And then the signature page looked like it came from a different document, and that was critical, because it turned out that one of the reasons that we had gotten involved in this deal is a high net worth investor who purported to have a net worth of like $50 million had pledged a good chunk of his personal assets, his personal collateral, on this loan that was supposed to be backed by his assets. Well, it turned out we should have asked for, and this is, again, something you don't think about, is like, well, is that really your signature on that guarantee? It turned out that it was not really his signature on that guarantee, that if we had looked at specimen signatures of his from other documents, we would have seen that it was clearly not. And it turned out, the scuttlebutt is that it was really his daughter who forged his signature on that document, because she wanted to do the deal, but didn't have the collateral to back it. So she knew her father did, so she got him roped in. It was a total disaster for everybody involved. Tens of millions of dollars just evaporated over the course of 3 years, and you couldn't make this stuff up in terms of fraudsters parachuting in from Portugal, purporting to, have money to rescue the deal, and then turning out to really, be another scam on top of a scam. The first guy who was involved really, was supposed to be building an airport in Belize. That, was never happening. Just an amazing cast of characters. Once this thing started falling apart, it was, we wondered how on earth we got roped into this in the first place. But initially, there were, as a typical syndication, there's a preferred return to investors, which did not seem out of the ordinary. It was like an 8% preferred return, and they were aiming for liquidation in 3 to 5 years, which is also pretty typical. And on top of that, the lead investor and partner in it was going to participate in the backside. We were all going to participate in the backside. He was going to take 10 to 20% off the top of that, depending. There was a sliding scale. They had escrowed money for those preferred payments in a separate bank account. And, for the first 2 years, payments came, and, everybody was happy. The progress reports were coming. And then it just fell apart over the course of just 2 or 3 months, when this person, wound up actually, going to jail for another fraud. And so, over the course of the span of about a week, we found, there was an article in the newspaper about the SEC filing charges against this guy. It's like, is that the guy we're doing this deal with? Mm-hmm. He's going up on charges for the SEC. What? And then, one thing fell apart after another. Then the payments stopped. And then it turned out that all these signatures were fraudulent that we heard from these other people. And then it was just like, once the smoke cleared, we just wondered how on earth we had been so stupid to get involved. But as I said at the beginning, when you've got all the right pieces in place, unless you look really, 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 really carefully, it's really hard to do diligence fraud. Because frankly, when I did my deal with Jonathan, which was exactly the opposite experience, I did exactly the same thing. I checked Jonathan's references. I checked other investors. I had my lawyer look over all the paperwork. The returns seemed okay. All the pro forma that he had done, all of the paperwork on the property, the descriptions of the property, all seemed, fine. And I had no problem, writing a check. But it could have turned out exactly that way.
So I have a question. So how does somebody, because it's not unsimilar. I've been involved on the same side where, we made an investment with a group and the first year was fine, no problems. And the next thing you know, one money's going here, something's going there. And you can do all the vetting you'd like. I mean, even on the contractor side, we had a contractor steal $1 million because he was basically using, putting bills into us, and we had a bank involved, investors involved, institutional investors involved that were overlooking every single step, and it still
Yep.
happened. So
Yep.
how does one person get over? Because I think that's an accomplishment, right? It happens, and it probably happened prior to Jonathan, and then another deal comes out. And how does someone have the confidence to go forward, or how does someone learn why they shouldn't go forward, or both? Both questions.
Right. I think one of the things that I learned and this is going to sound paradoxical, but one of my new rules is never invest with anybody you haven't already invested with before. So the question, it's impossible to follow that rule if you've never invested with anybody before. So the trick is, how do you get that first deal going and build a trusted base of investors? And there, for me, like, it took me several years of knowing Jonathan before I invested with him. I met him at, we both went to Harvard, so I met him at some Ivy League networking event. There were a bunch of other people in our circle who knew him. I began to be friendly with him. I saw him at a couple of social events, so I got to know him as a person, which was not something I had done with this fraudulent deal. Because if I had spent more time with these people, my internal bullshit detector would have gone off, and my radar, would have sprung into action. Because you can tell, I think, even though fraudsters are very good at dissembling, you can, I think, tell if you've known people for a while, whether they're telling you the truth or not. So that's certainly one thing. Is you make sure. Yes, do the due diligence on all the numbers. Make sure the paperwork is in order. Make sure the deal vets. Run it by a few friends of yours who've been real estate investors. Run it by your attorney and run it by your CPA. Right, both of those. You need to have both your attorney and your CPA run through a deal. Even so, if you haven't spent quality time with the person, the lead partner on this, who is leading the deal, the syndicator, then you are not doing enough. Go have a beer. Yeah, it's difficult in the time of COVID, but spend a lot of time on Zoom with the guy. Have virtual beers on Zoom. That's a critical part of it, because at the end of the day, I think John, you said, or Chris, you said it earlier when you first started working with John Toro 5 years ago. He could have been a scam artist. How did you know? You spent time with him. You spent time over beers, over dinner. You got to know him as a person. That's ultimately it's trust, and that trust is developed between people who treat each other as peers and really get to know each other as persons. So unless you do that, that's a critical component of due diligence, which I think a lot of people overlook, is before you invest a dime, you invest time in learning about the person that you are investing with. Get to know them as a person, not just talking to references, but spending time with them over a meal, over a beer. Got to do that.
No, I think that's important. And on the flip side, and self-serving to a degree, I think it's important that not only does an investor or a potential investor do that with whoever's operating the deal, but the flip side of that, if the sponsor's not asking you the same questions and wanting to do that with you as the investor or potential investor, that raises flags for me, because my biggest problem, and one of the reasons why I reached out, was you see today online, it is so easy to raise money, and there's so many websites, and the power of marketing and Facebook and social media. There are people that are raising millions and millions of dollars for deals. And these are people that they just took a class and now they go out and raise $10 million. And there's not enough education on the sponsor interviewing the investor. I mean, we do it frequently where, every person that comes into our office, our system, whatever it is, we have a 45-minute call just to introduce ourselves. Additionally, get to know the investor. I don't think enough sponsors are doing that. And I'm sure in your situation, whether it happened or not, a lot of the times it's, hey, give me money, give me money, give me money. And investors do it because people realize, like, I want to be involved in real estate, or I want to be involved in whatever the syndication or whatever the investment is, that sometimes they put blinders on because they want to be involved. But at the same time, you want to know who your investors are. You want to know that the individual can support the investment. So in case it goes bad, you're not ruining his life. You want to know the investor is understand this. And one thing that we do, and I like that you spoke about it, before we ever take a check from anybody, we make sure everybody understands what our operating agreements, what our private placements, what they look like. So we'll send them past deals, and I tell every one of them, I won't have another call with an individual until you've reviewed it, spoke to your attorney about it, spoke to your accountant about it, because 9 out of 10 times people just sign on the dotted line. No one even reads the agreements. And then you look back and you're like, oh my God, I can't believe I missed that. Why was that in there? And I think that's left out, because if an attorney reads that and says, there's no way you're signing this, I'd like to know earlier so I don't waste my time going down a path with an investor. And simultaneously, if the investor doesn't ask that question, it's sort of shame on you to a degree that you didn't even know what the pitfalls were to even ask the question.
Right,
and
exactly.
That's the root of it. And that's where, the education lacks. The education out there is, put your numbers into this model, it spits out a return, and the deal's going to work. The education isn't on why that operating agreement is shit, why that in subscription agreement doesn't work, or why this deal's not going to work. It's basically just, how do these deals work? And on a piece of paper and Excel, you change one number and the deal works. But that doesn't mean it's actually going to work. So making sure you have a trusting relationship and the individual is critical, because at the end of the day, you're investing in the property, but you're really investing in the individual to make it work. And I don't think people do that enough.
Yeah, exactly. And that's, I think you put your finger on one of the things that for me was a green flag with Jonathan, is that he spent an awful long time talking to me about my background, what it was that I had done, what my experience in investing in real estate was, and so on, so that I got the sense that I might not actually get accepted into this deal because I might not meet his criteria. So I think it's important for sponsors and syndicators to have criteria for their investors, as well as for investors to have criteria for what they're investing in, because that trust goes both ways. Because so often what if there's a capital call and you can't rely on your investors to meet that capital call? Well, then all the other investors get screwed. So everybody has to be on the same playing field in terms of capacity to take on that deal in order to make the deal work for everybody.
Exactly. And that's a huge piece. And just understanding who all parties involved and getting to know them is important. Because I remember this Saturday, I actually had a meeting with an investor of ours that I've known for probably about 6 years. He has not invested yet. And I actually got home from that. We grabbed coffee at a place over here, one of the places that you're still allowed to in New York. And I actually came home, and my wife was like, is he investing? I said, no, it's not. I don't know if I want him as an investor yet. And simultaneously, it's a time process. You can't expect to meet someone one time and then write you a check of 5,000 or 50 million. It's a time process, and understanding that, like you said, is critical. And I don't think the raising money side of this business is very easy to build an automated campaign with Active Campaign or MailChimp and get people interested. But I'm not a big fan of the systems that are out there of the investor cultivation, because I think it's before that, right? Anyone could go into an automated computer system and it's a marketing, right? Marketers do it really well. They can get somebody interested by
this is all
emails.
It's all funnel management 101, right? How to start with a cold list and generate qualified leads at the bottom. But that's just a mechanical process. There really is a lot more to it than that.
Exactly.
Yeah. I remember having two conversations that I think might highlight the different sides for people. One, I don't know if I've ever spoken about, but had a call with an investor and was just doing a lot of that stuff. And then at the end of the call, before I could even say what we were going to send, he said, can you send me the PPM so I can take a look? And I said, yep, it'll be in the, the package we send everybody. Came back to me maybe 2-3 weeks later and said, hey, can we talk again? I saw some things in there that I want to discuss with you. I said, sure. Hopped on the phone. He probably had about 7 or 8 bullet points of questions or things that, he just wanted to go over, and was asking about, is this the same as every single one? And obviously it's always slightly different, but the meat and potatoes of it remains the same. And at the end of the day, he didn't feel comfortable with the PPM we had in place, just because some of the language that was in there are things that he was looking for. And, obviously I don't want to lose somebody as an investor, but I was actually very impressed because he's the first person I ever had take a look at that document and actually have things to come back with and talk about. And it's not easy, right? They're long documents. I mean, you got to really sit down and take the time to read through it. But it's important because when and if things go wrong, that's the sheet of paper that, you're kind of going to rule your life by and your investment by. So I thought, that was really powerful. And then the flip side of that conversation, which I've spoken about once or twice on here, but just to bring it up again, was having a conversation with an investor. And it was one of those guys that John was talking about that just wanted to be in commercial real estate, wanted to do whatever. And the intro call lasted like 10 minutes because he had no interest. And then I had, a couple other conversations just trying to feel him out. Eventually had a deal we were raising money for and just, put it in front of him just to see what his feeler was. And I was trying to, go through the deal with him, explain it. And he cut me off and said, stop. He said, tell me in 30 seconds if I should invest in this deal or not. I said, honestly, we're done, because if you can't even sit down for 5 minutes, 10 minutes and listen to why I think you should invest money into a deal, not even spend your own time to look over for it. I said, I just don't, think this is the right thing for you. I'm not your financial advisor. I'm not here to tell you what you should or shouldn't do with your money. So I just think it showed, those two conversations always stuck with me as kind of the two very opposite sides of the coin.
Right. I think that brings to mind what another, one thing I mentioned about how to sort of due diligence against fraud is, it's important. My lessons learned are don't invest money with anybody you haven't invested with before. But in order to get to that point, you got to personally know the person. So that's an important part of the due diligence. The other thing to do, and which, this sorry episode taught me, is that it's important to ask, what are the things that need to go right in order for this deal to work out? You certainly want to ask what can go wrong, but if you ask what needs to go right in order for me to make any money, if that list is really long, then it's probably a lousy deal, right? And when I look back at this, I think, wow, I should have there were not only, there was a fair amount of things that could go wrong, but we thought that those had been covered with like this personal guarantee from a person who had a $50 million net worth. But what were the things that needed to go right? Well, there was a building that was being converted. It was an old, office records building, which was a great building, solidly constructed, 20-foot high ceilings, built to hold documents. So very, very heavily constructed, plus a beautifully architected building with tall windows and, nice details built, I don't know when, in the 1920s. So we thought, wow, raw material is really great. But what needs to happen? Because this was a conversion, you've got all these permits that need to happen. Are they allowed to do this? You have to convert it from one use to another use. Then you have to finish the build out. Well, there's a lot of moving parts there. There's HVAC and electric and roofing and windows. All those systems are going to be replaced. You're going to put in an elevator. You got to put in an underground parking under this enormous building. You're going to excavate and put in underground parking. Jesus. Okay. Then, assuming that all of that goes right, then you've got to market this thing and sell it. Well, you're going to market it to, this was in Westchester, you're going to market it to downsizers who want to get out of, $2 million houses and into $1 million condos. Are they really going to go into $1 million condos? Wouldn't they just go into $1 million houses instead of $1 million? I don't know. I mean, is that really a market? I mean, do people want that? And are they going to want to? The location was also, not the best. It was close to, but not right in an amazing neighborhood. Are they going to they're going to spend $1 million? Don't they want to be like in a good neighborhood? So the marketing has to be, so this long list of things, which absolutely they needed to get all of them right? Because you couldn't do a shoddy job on the renovation, because then you couldn't market it to folks downsizing from $2 million houses. So you absolutely needed to get that right. So that meant that like 14 things needed to go absolutely right for this to make any sense. Boy, that should have raised a lot of red flags.
What were you going to say? I'm sorry.
No, no. So that was a huge lesson for me. And then, and one of the reasons that I like, local multifamily investing is very little has to go right for me to make money. I need to buy it at the right price, so I can't overpay. So that's why it took me 5 years to buy my second property in Woodstock, because everybody in Woodstock is insane in terms of their expectations for cap rates. They think this is New York City. And every time I've talked to a broker up here, they offer me the same. When I roll my eyes and I show them my pro forma, I say, this points to a cap rate of like 2.5%, which is ludicrous. She said, well, it's Woodstock. It's like that. Well, your seller's crazy. That's what I have to say about that. Um, so I have to buy it at the right price. I have to have demand in the market for the goods, the apartments, and I got demand up the kazoo here, and I don't have to worry about financing. I don't have to worry about selling the thing. I don't really want to sell it, so I'm not expecting to do anything but generate positive cash flow at a decent cap rate forever. Not a lot has to go right with that. But the few things that have to go right have to absolutely go right. You cannot overpay for that.
It's funny. So we're looking at a deal right now, buying it in cash. It's 60% occupied, and you're going through this process. I don't think people ask you, okay, everyone wants to know why is it going to go wrong? Like, what's the worst thing that's going to happen? But that question will uncover so much more. Like, if that list starts piling up, it's like, well, if that has to go right and it doesn't go right, and you've already addressed the things that can go wrong, there's a lot of mistakes here. So when we're looking at deals, I talk about it all the time. If the deal doesn't work the way it is, if you have to make it something different, that's already a challenge that I want to be compensated for. Listen, I think anyone should have a little bit of diversification in their portfolio, and if they have a little bit of risky capital, that's fine. But at the end of the day, I was just talking to my partner before a 10 o'clock call, and I said, we're buying the deal in cash. He's like, why don't we get debt? I said, it's 60% occupied. We're in the middle of Corona, or the end of Corona, hopefully. I said, I don't want to have the risk of a bank knocking on my door for a 60% occupied property in a $2 million purchase price with $1 million renovation. I said, there's so much that can go wrong. That's expensive debt. I said, if you buy it with cash, you could easily pivot. Okay, it's not going to work this way. That's fine. But at the end of the day, I want that deal to make sense the way it is, because that's historically what it has been. And I think because the last 10 years or the last 7 years has just been mistake proof, although there have been deals that haven't worked and people have made mistakes have been hidden. So people don't even know what has to go right realistically
Yeah.
for the deal to actually work. So I think that's an amazing question that any investor, any sponsor should ask. I have a list of questions that when I talk to brokers or sellers, and it's about 25 questions long, and it's the same question 3 or 4 times, just worded differently.
Mm-hmm.
Because you first ask on a scale of 1 to 10, how's the location? An 8. Okay. Later on a scale of 1 to 5, how's location? A 3. Well, that math doesn't work. How can it be an 8 on 10 but a 3 on 5, right? So then you answer your questions and you paint your own picture, and you're like, okay, I'd pay a 6 cap, an 8 cap, a 4 cap. And then next thing you know, it comes out, the taxes are wrong, the insurance is wrong, the operating expenses are wrong. And it comes out and you show a broker, you're like, this is a 3.5 cap. Well, that's the market. Well, I live in New York. That is the market in New York. That is not the market in a Midwestern market or a Southern market. It's just not the case. So I think that's super powerful, and I don't think people do it enough. And I'm sure experience has helped you ask, when you look at something, listen, is there something wrong with that? No. But, the last 2 deals we purchased were 100% cash because of the uncertainties of not knowing what's going to happen. And this deal, I'm penciling out as all cash. And listen, it's not going to be a $20 million deal in a huge syndication, but at the end of the day, we're actually investing 50% of our own money, because almost every single deal we've done, except for probably 1 or 2, we have not, our personal capital, myself, my partner, my partner's father, right, has been 30, 40, if not 50, 60% of the capital, because we're not looking at deals from a standpoint of, I just want to make a lot of money. It's, if I'm not willing to commit and this just has to work for me, how can I go look an investor in the eye? So I think that's super important. And I love it because people aren't asking that question enough. And it will tell you more about the property and the sponsor or the person running the deal and what can go wrong. They know the what can go wrong because everyone's asking them that other question's not necessarily being answered. So I think that's important.
Great.
Yeah. So
Yeah, I've also learned a thing or two about. Oh, I'm sorry. Go ahead, Chris.
yeah, I was going to ask on that deal that went wrong, that was this whole big conversion. Had they done other deals similar to that in the past or no?
Yeah, that was the promise, is that they had done a, in fact, immediately prior to that, they'd done a successful hotel conversion. And part of it was new construction, but part of it was conversion of some existing, the factory loft kind of thing into this really chic hotel. And from all, and in fact, that hotel was so successful that they were using, the cash flows from that. That was another piece of collateral that was being pledged, was their interest in that hotel. So it was like, oh, here's a successful. They've done this before. They just did it nearby. They did it in a hotel conversion, not a condo conversion, but it worked. They did a great job. They got a thriving hotel. They got a thriving restaurant. It's generating a lot of cash, and that cash is going to, backstop, what happens here. So yeah, they had some we thought very relevant experience at doing something very, very similar in a very nearby market, very similar market that turned out really well.
Mhm. Do you know if did they actually do that other deal, or was that postulating?
No, they actually did that deal.
Okay,
They
gotcha.
actually did that deal. I mean, it turns out that there was, you can't make this stuff up. It turned out that there was a whole bunch of, inter-family issues there. An estranged daughter, a divorce, another fraudulent investor parachuting in from a foreign company, somehow getting control of that, siphoning cash off, causing that property to get put into bankruptcy.
Hmm.
So not only did they, this had a whole cascading series of disastrous effects because it spread like a cancer. Because they were all these bad actors, they destroyed, not one but three properties. It was just insane.
Hmm. Gotcha. So what, I know we've touched a lot on like things you're looking at differently, things you would do. But is there anything for people that maybe don't want to be as drastic, right? Because I think a lot of people aren't as fortunate to be able to buy several deals with no debt, or are looking to get involved in commercial real estate and want to do it with syndication because they work a 9 to 5 or a 60-hour job and they
Right.
can't do it themselves. Is there any advice, tips, tricks, things that you would encourage people to look for as they do look at different options?
Well, I think that John was alluding to it a minute ago, is that over the last, 10 years, it was really hard to screw things up because, we're in a falling interest rate environment. So debt was very forgiving and very available, right? We're sort of in another debt bubble. And, if you weren't in one of those high priced markets like New York, you could get deals at reasonable cap rates and the debt to go along with them to make them work. Through Jonathan, I was introduced to some other real estate investors, all over the country, and I was talking to these guys who invest in Indianapolis, and it's like those cap rates are like, 10, 9, 10. It's like, wow, holy shit, that's amazing. I could never get that here, and even in upstate New York, especially now with everybody, with demand increasing for these properties. But there are parts of so I'd say, look farther. Teach yourself how to create a pro forma, how to calculate a net operating income, how to calculate a cap rate, talk to a broker, cultivate your network of brokers to see if perhaps there is a 2-family or a 3-family, a small property that you can buy where the numbers pencil out, where you can get a competitive cap rate to what's going on, and you can get the debt to line it up, and somebody to manage it for you. And I'm thinking about, Chris, your scenario of a person who's working a 9 to 5 job, limited cash, maybe limited experience, who just wants to get their feet wet. A typical way to get your feet wet is you teach yourself the basics, you work with a local broker who understands the market, you identify specimen properties that meet your criteria, small 2-3 family, properties where you can arrange the debt, and you don't have to come up with, much money. And if that's not your local market, you can, find a market that is. And, there are folks out there who will manage these multifamily properties for you. Before we started managing our properties ourselves, because we, figured out we got our ecosystem set up. We've got our plumber and our electrician and our handyman, and we've got the guy who mows and the guy who, we got all of that stuff. I do hardly anything, except send a couple of texts. So why am I bothering to pay somebody 10% of what I'm earning? That takes a big chunk out of my return. But, you can do that all day long. There are all sorts of, there are people who are more than willing to take your 10% to do the heavy lifting for you, placing those phone calls and taking those calls at 2 o'clock in the morning if the toilet's overflowing. But I think that's the only way I know of to really get started here is self-education. If somebody just insists, I got $10,000 burning a hole in my pocket and I want to be in real estate, then the first thing they should do is sit down in front of their computer and start teaching themselves about the basics of how do you do that? How do I evaluate an investment? And that will also teach them about the variety of options, right? I mean, I would start with a local market, with a local broker, with a local banker, and just educating yourself about your local space, what kinds of deals are available, and only then, think of it as a series of concentric circles where you start, as you get more interested and more sophisticated, then you can start investigating, a syndicated deal. I don't think of those as deals for, a 9-to-5 guy who has limited money and limited time and who wants to get involved in buy a REIT. You could buy a publicly traded REIT. Go to Fidelity or Schwab and use their tools to do some research on a REIT. You'll get your 7-8% return, and you won't have to talk about truly passive investing. You won't have to worry about a thing. I don't have to worry about syndicators screwing me over. It's a publicly traded vehicle. Yeah, I have to worry about the whole market going belly up, or that sector going belly up. If it's malls, if I bought a mall REIT, maybe I'm thinking twice about that now. But, if you buy a multifamily REIT or an industrial REITs are apparently doing very well, right? Industrial space, people are buying warehouses because everybody, all the Amazons of the world and the Walmarts are buying space to house goods as transfer stations and things because we're all at home buying goods over the internet. So some sectors are going to continue to do well, but why bother getting into a syndication if you have limited time and limited money? There's such better options for you. I think they're really for only if you've done your due diligence and you've spent some maybe months or maybe even years educating yourself and knowing the people in your industry. And that goes back, John, to the point I made earlier, is like spend a lot of time over coffee with people who are local real estate investors. And that's how you get to know them and you get to know whether the deals that they're pushing are legit deals or not. Only then, I think, would you even consider, going in on a syndication, because, you generally need to be an accredited investor anyway. So
it's funny bringing that up because I think it makes sense. I don't think there's enough people at least educating themselves. I understand Chris's point, and listen, I know there's an appetite for people that just say, shit, I'm going to throw 10 grand into this deal. I'm going to go to a website, a crowdfunding site. And is there something wrong with that? Listen, at the end of the day, you have to be able to go to sleep with yourself, right? You're going to bed. So if you feel like that 10 grand, 20 grand, 100 grand, whatever it is, if you can go to sleep making that choice, I think that's the first question you ask yourself. But the second piece is, I know when we were all younger, teachers always used to, there's no such thing as a dumb question. There's no such thing as a stupid question. In today's world that we live in, there actually are stupid questions, because if you take 15 seconds and Google anything or YouTube anything, you typically get your answer. So if you feel that you just want to self-validate yourself by asking the question and you haven't given a second of education behind it, I put that in the stupid question bucket, because I'm not saying you can't call me with a question on underwriting because you're not 100% sure and you didn't look it up. But at today's world, it's like they said, you never have a calculator in front of you, right? And you do. But today it's so powerful to go on the internet and spend 15 minutes educating yourself Then if you say, you know what, I don't want to invest in a syndication, I want to buy a duplex, or you know what, I really don't want to deal with a manager ever calling me, I want to invest in a syndication. But everybody out there, they should take 10 seconds, 15 seconds, go online, type in the question. Google even knows what you're going to ask before you ask it when you start writing your question. So from the 9-to-5er that has no education, I do think everybody has to go through the motions themselves at least once, whether that's making an investment, buying a $15,000 duplex or a single family and losing 15 grand sucks. But the education you're going to get from that, and I've said this on a lot of our episodes, is the best education you're ever going to get. And now you can say, okay, I've made a lot of mistakes. I know what to ask. And simultaneously, I know this is for me or it's not for me. Let's try something else. But I don't think people do that enough. I think it's a very easy way to just go in and click a button, and everything now makes life so easy that people get caught. And I agree. And I'm in the boat, right? Yes, I've owned real estate for a while in my own deals, but I've syndicated deals in the last 8 years, or 7 years, whatever it is. I've benefited from the best market in the world. You could have made a mistake and you still get out unscathed, but I know that. So when I'm going into deals now, I'm looking at it from, this might have worked 3 years ago, but I don't think it's going to work today. And I know we spoke about it on the episode with Jonathan, and you mentioned it loosely, whether you knew it or not. I don't think debt should be the driving factor behind your deal. Your deal has to be a good deal, and the debt has to accommodate it, or the debt has to add gasoline to the fire, and it's going to make it a tremendous fire. But the deal has to work for what it is, debt or no debt. But if you're buying deals because the debt fits it and that's why you're achieving your deal and your return, that's a recipe for disaster in the future in my eyes.
I think you're absolutely right. And I think what I was going to say earlier to Chris was I think what's absolutely critical, and this is where a person's real estate education should start, is understanding what makes a good real estate investment, and that means understanding how to underwrite a deal, which means getting a handle on a P&L. What's the income? What are the expenses? What are all the potential incomes and all the potential expenses? Even if you're looking at a REIT, it's like, okay, well, this is a healthcare REIT. Okay, well, what are they investing in, and how do those buildings make money? You got to know that, because what are you going to throw $10,000 in investment? You have no idea how they're going to make any money? No, Google is there for you. Google is your friend. So if you're doing this by yourself, it doesn't take long to understand the rudiments of how to construct a pro forma spreadsheet and how to, construct all the components of a P&L on a property by property basis, so you can calculate a net operating income and then calculate a cap rate. And all that's independent of debt. I mean, that has nothing to do with debt. Net operating income has nothing to do with debt. That's before debt service. It's irrelevant to debt service. And that's how you evaluate a property. That's how you have apples to apples comparisons. And then you can determine, as you said, John, I think that was a good analogy. It's like, wow, is debt going to make this deal better? Could I juice my cash on cash returns by using debt here? And what could go wrong? If I use debt, now I'm going to have a partner, right? The bank is going to be my partner. Are they going to insist that I escrow money? They're going to ask for a debt service coverage ratio. They're going to ask for all kinds of shit. Do I really want that? Is that worth the brain damage to have that, to juice the returns? Now I have something to weigh. Now that's a whole other consideration. Then you've got to go to your funding spreadsheet and you have to layer that in and ask those questions. But just the whole discipline of due diligence and looking at expenses, because they're all, after you've evaluated enough of these deals, even if you're looking at a REIT or you're looking at a syndication, you just have to assume that at least half of those numbers are wrong. You're just going to say, those could be 10% too high or 10% too low or 20% too high. I don't know. So we need a fudge factor in there. So whenever you look at any of that, you should think, well, if these numbers really are wrong, what's the worst that could happen? Let's add 10% to those expenses. Does it still work out? What's your margin of safety, right? So you build in your margin of safety by saying, gee, even if my expenses were 10 or 15% higher, this would still be a killer deal. I'm definitely doing this deal. If you don't have that margin of safety, there is no deal in my mind, because if the numbers have to work out, this is what goes back to that, what needs to work out right? Well, all the expenses need to be spot on with exactly what I put in my spreadsheet, Otherwise, we don't make any money. Like, no, bad answer, wrong answer. You know, if they are within your margin of safety and you've got a margin where your expenses could be 10% or 15% higher and you could still make a killing, that's a deal you should run after with both hands.
Yep. So it's funny because we've looked back through the broker OMs over the last 5 years, and now that you've been in this, that I've been in the space long enough, you see the same deal trading 2 or 3 times. So the deals get listed, and I download the executive summary or the broker book, and then I pull up the old one, and the income and expenses are lower than what the broker pro forma'd or what the actuals were 3 years ago. So I'm probably torching the earth I walk on when it comes to broker relationships, because I look at it, I'm like, guys, here's your OM from 17, here's your OM from 2020. The expenses are actually higher than what you projected, and they're also higher than what the T12 was, and the income's lower. So the only reason why this deal is worth 20% more is because of interest rates falling and the market cap rate has gone down. At the end of the day, cap rate and debt they don't go together. A cap rate is an all cash purchase, and a debt purchase, yes, you could buy a cap rate with debt, but it's going to change your return. But at the end of the day, the deal's performed like shit, but because the market says it's worth more, it's selling for more. But how am I supposed to buy that, being that the last 3 years, which have been utterly phenomenal, it hasn't been able to perform? And they basically look and basically say, I've had this conversation over the last couple of weeks. I think you're just too educated for this one. I'm like, really? That's really, you're telling me that I know too much to buy?
You know too much. You know too much for this deal.
and I said, so you're basically looking for the greater fool theory. It's a game of hot potato. And now, so more than ever, don't be the person that gets left holding the bag, because I hope nothing happens bad, and I hope the market continues to go. But real estate's a cycle. It's been a cycle historically. Now, maybe this little blip that we had is the down, and we go for another 10 years. But at the end of the day, when brokers are telling people they're too educated, scratch your head. One thing that I'm actually putting together, and I'm working with a couple brokers on this that I haven't pissed off yet. I want to see all the transactions that happened from 2010 to 2016. And then I want to see 16 to 20. And one thing that's going to be interesting to look at, who was buying deals from 2010 to 2015 or 2018, and who's buying deals from 2018 on, because you'll see new names on the tail end of that graph, and you'll see the players that were experienced probably aren't buying as much today. So it makes you think, it's like when Bitcoin was at 18,000 and your grandma was telling you about it. Now it's higher, but you're going to get new groups that are coming out of the woodworks that were not buying deals then and are buying now. And that's a red flag to say, wait a second, the super smart guys aren't doing it, so maybe I should think twice. Now, I also believe in, if the herd's going this way, be different, but just understand the components of both elements. And I think if you understand it and you ask the right questions and you educate yourself, and you make some mistakes. Listen, everyone's going to make some mistakes. You have, I know Chris has. You got to learn from your mistakes. So I think that's a great place to wrap it up. I won't steal Chris's thunder, so I'll let Chris finish our exit.
Yeah. Tony, thank you so much for coming on. If people want to learn more about you, follow along with you, or check you out, where can they do all that?
Well, I have a blog, and which really doesn't have anything to do with real estate, but it's all about my explorations of personal freedom. It's called declaringfreedom.com. And you can always reach me at tony@declaringfreedom.com. That's the email address that goes along with that. But check it out, leave some comments. And, my real estate investing is all part of my financial freedom component of personal freedom. So I'd be interested to hear people's comments and be happy to talk with them further about that.
Yeah. Guys, definitely go check it out. I was reading 2 right before we started recording, and I love them both. So I'm definitely going to, I don't know can you subscribe? You can subscribe to blogs, right?
Yeah, you can subscribe.
So
I won't flood your inbox. I only write once a month. So
once a month? Okay. Yeah, that's what I was going to ask.
Once a month.
All right. We'll have to pressure him into writing more frequently, guys. But definitely go check it out. I did. It was good. So be sure to do so. But thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that you think would get a tremendous amount of value from this episode. Tony, once again, thank you so much for coming on.
Thank you, guys. Happy holidays.